Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. On the show today, we'll chat with Ramon Barua Costa, CEO of Aclara Resources, rare elements mining company. Its stock has rallied almost 500% over the past year. We'll dig into the company's operations and current projects today at 11:50 a.m. Eastern Time. And now some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada's economy posted modest growth in February. Data from StatsCan showing GDP rose 0.2% in line with expectations following a smaller gain in January. The increase was driven by strength in goods-producing industries, including manufacturing. Early estimates suggest growth stalled in March, though. The economy still expanded in the first quarter. Shares of Bombardier are seeing a surge, that after the jet maker posted strong first quarter results with both profit and revenue up from a year ago. The company says the results were driven by deliveries as well as strong demand for maintenance and support work. Bombardier also saw a sharp rebound in free cash flow and raised its full year outlook. Shares of Ford Motor Company are sliding right now. The automaker posted higher revenue and profit that exceeded estimates, but the company is warning of pressure from an unexpected rise in commodity costs and expects a $2 billion profit hit as a result. On the upside, Ford raised its full-year profit outlook due to demand for high-margin pickups and SUVs. And a quick look at the markets right now. And the TSX, actually, we're going to go in the U.S. markets first, and you can see the rally happening there. The NASDAQ lagging a little bit, though, but S&P 500 up by 0.4, Dow up by more than a point, and the NASDAQ is up by 0.15%. And the TSX today, it is up. Look at that, now above 1%, doing nicely. Pretty much all sectors in the green except for tech, off by 0.94%. Healthcare leading the way, up by more than 2.2% right now. And it appears Canadian markets are holding steady today despite a volatile global backdrop. Investors here weighing the impact of the Fed's decision to hold rates along with the latest big tech earnings and what they signal for global growth at the same time. Ottawa's proposed sovereign wealth fund is adding another layer to the debate around long-term investment in Canada. So joining us now to put it all in context, and there's a lot to put in context, Teresa Schutt, Chief Investment Officer at Harbourfront Wealth Management. Teresa, thanks as always for joining us.
Pleasure to be here. Good morning.
All right. Is it a good morning? What do you think?
I think so. I think, it is interesting. I think, we're having a bit of a change in market psychology. I think we saw that with how, the market reacted to, the four big tech names that announced their earnings. Obviously the standout was Microsoft, clearly beating expectations. But Meta was the outlier. So, really despite better reporting or better than expected Q1 results, the stock shed more than 10%. And this is really related to their CapEx outlook. And so, going as high as $145 billion, that's a big number. That represents, about 80% of a jump from 2025 and has led to one investment bank, which is JP Morgan, actually downgrading Meta from overweight to neutral. So I think it's kind of kind of a shift or a pivot. And what we're seeing now is really the market is looking at the monetization front. So there's no, kind of theory of just like all rising tides raise all boats. Mm-hmm. I think people are starting to, look at, kind of what's behind the numbers. And I think with Meta, I think their challenge is, in this kind of all stack AI play is they really are a single source of revenue, which is advertising, which is frankly cyclical. So, if things do slow down or a recession hits, they could be having some difficulty. And I think we're seeing that. So it's not just because they're, AI adjacent, that they're going to get the benefits of a rising, tech market. I think we're starting to see that bifurcation. And I think that's important. We always knew that we were going to see some winners and losers. And I feel now the market is finally, really looking at the longer term view as opposed to just, like continuing the party until the bar closes.
And we're seeing the tech market here is off, the tech index off today by around a point. So people do seem to be reacting, don't they, all across the board?
Yeah, I think so. I think, look, and hyperscalers, they're accelerating spending into, what I would call is an environment of pretty, rising input costs. And this has really been exacerbated by obviously the conflict in Iran, the impact on energy and supply chains. And I'd say, the really better beneficiaries of this now are power companies, data centers, copper producers, chip manufacturing. So I think, yes, they beat expectations, but again, we have to see that monetization. Microsoft is now, I think, signed up 20 billion in Copilot licenses. That's great, but that's a far way from really making, the spend, profitable.
All right, let's talk about the Fed. Rates held steady, but some dissent. And we have a new chair coming in at some point, somehow, somewhere. Where does that leave it all?
Yeah, I think, to no one's surprise, the Fed held interest rates steady for the third consecutive policy meeting this year. Everyone expected that, but I think, what is starting to emerge is the dissension. We had Stephen Moran, who wants to cut interest rates, and then we have the remaining three of the dissenters really pushing to change that language away from that easing bias and more towards, I think, a more balanced chance of an interest rate hike and, interest rate cut. So, we saw the bond market obviously react. They pay a lot of attention to these announcements. 2-year treasuries obviously jumped higher. And I actually look to the bond market more than to the equity markets in terms of really kind of, understanding the broader inflation picture. And so I think, Warsh is inheriting this kind of more divided bank or Fed, and I think it'll be interesting. I mean, he has talked about making some pretty significant changes. To quote him, he doesn't mind, messiness. So, if there's kind of real-time disagreement instead of these kind of pre-choreographed decisions, I think that would make things, I think it'll certainly make things a lot more interesting. And so, and it sounds like he's ready for the challenge. And obviously Powell is going to stick around. I think, I myself take a bit of comfort in that. Maybe that kind of, still, helps us with that Fed independence issue. And, he's a bit indefinite in terms of when he wants to leave. And I'm sure, he'll pick the right time. But I think that kind of continuity in leadership does give the markets some comfort.
And where does that, and with the bond markets, what are you doing with that, or where are investors going with it?
Yeah, I mean, the bond markets have been, obviously very volatile. They haven't done as well under Powell's leadership. But I think, it's one of those things where, it does offer, depending on, where you are, diversification, whether you're investing geographically, whether you're in corporate versus government, obviously it has to be part of your investment portfolio. But I think, again, I think you need to think about other asset classes as well, whether that's privates or hedge funds, because, the correlation between bonds and equities is becoming increasingly positive, particularly in a higher rate environment. So I think, bonds always have a place. And I think they're a great kind of bellwether to understand, where inflation is going globally. So I think it's a good sector to watch to inform your investment decisions. But yeah, obviously a part of your portfolio.
And I just want to ask you about Ottawa's announcement, the $25 billion sovereign wealth fund. Your thoughts on it? Enough? Too much? Is it going to get in the way? I think you have an opinion, though, I'm going to guess.
Yeah, I do. Look, for over 10 years, and I've talked about productivity a lot, like sluggish business investment has dragged down our productivity and wage growth. Canadian workers earned 55 cents for every dollar invested in comparable, based to comparable U.S. workers. So, we've kind of let this lag for a long time. And so, in theory, a sovereign wealth fund could help close investment gaps. De-risk private sector projects, that's really important, improve productivity, open new export markets. But this is not a wealth fund. This is a debt fund. This $25 billion is debt financed. We suppose, I mean, they've been kind of quiet on that front. And it's being launched now when we have a $78 billion deficit. So this is really getting financed by, debt and not dedicated revenue streams or fiscal surpluses, which is what we see in Norway and in the Middle East. So it's really, not a true sovereign fund or wealth fund. And it's not really looking at, outside of Canada. It's focused on Canadian investment. So that's sort of unique. Most of these sovereign funds look at global investment. There's always that risk of political interference. Could it become a slush fund for government pet projects or corporate welfare rather than being truly commercial, which is what they're saying. I think there's a lot of overlap with existing agencies. The Canadian Infrastructure Bank, for one, that really hasn't, I think, been successful. So hopefully this is just not, one of those stories, which speaks to just the track record of government investment in Canada. And I think many would still point to the fact that, maybe it's not the dollars that are the issue, it's the red tape. It's the regulation, the high taxes, all those burdens that really deter investment. So I think it's yet to be seen. I mean, it's not a lot of money. I don't know that it could move the dial. Okay. But I think they're looking for retail investors. But what does that look like? Is it an ETF? And really, this is really a vehicle for patient long-term capital. Less so for maybe retail investors looking for liquidity.
All right, we have to wrap it up there, Teresa. Always a pleasure. Thank you for joining us.
Great to be here. Thanks, Roger.
Teresa Shaw, Chief Investment Officer at Harbourfront Wealth Management. Coming up, today's market drivers with Bloomberg's Monique Malima. Time now to take a look at today's market movers, and we are joined by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. Let's get right to it. We've got a busy lineup here. Ford's up first. Some disappointment there.
Yes, so Ford shares are trading lower this morning after the company reported their quarterly results. Their earnings per share actually beat analyst expectations, but this was largely driven by a one-time tariff refund. They got over $1 billion refund from some U.S. tariffs that were overturned by the U.S. Supreme Court. So while they were able to beat, this isn't going to be something that they will necessarily be able to replicate in the next quarter. Analysts were also not enthused with their guidance. They said that it was somewhat weak, and Ford is also expected to see higher costs going forward because of rising commodity prices.
All right, ConocoPhillips feeling the effects of the war.
Yes, so ConocoPhillips, their shares are down this morning after they reported that their first quarter production fell year over year due to the war. They have some operations in Qatar that were disrupted by the conflict, so that led to those production declines. And the company also announced that they were raising their capital expenditure guidance, and this was also due in part to the war. They said there's still a lot of uncertainty in the Middle East. And then they're also seeing some more investment in the Permian Basin, which is going to raise some of those costs. So analysts had a bit of concerns about the higher spending.
All right. Equinix getting a bit of a raise, a boost.
Yes. So they reported their earnings. They did slightly miss. But this was largely due to the fact that one of the large bookings that they were expected to have for a lease in Atlanta got moved from the first quarter and pushed out into the second quarter. So analysts are still largely positive because this is still something that is going to happen. It's just going to be a little bit later than previously thought. And they also see a stronger outlook ahead compared to the results from this quarter. The AI demand is continuing to pick up, and as this company leases land for data centers, they're expected to benefit and to see growing bookings from this decline that they saw in the quarter.
All right, and Valero Energy coming up short on cash flow.
Yes, so Valero Energy, their shares are falling after their cash flow from operations for the quarter fell short of analyst estimates due to some working capital headwinds. They did see some improvement in their refining margins, which helped boost revenue, but this wasn't enough to offset some of the declines they were seeing in cash flow, which is part of what analysts are really focused on today, is how they can continue to generate more cash flow going forward.
All right, Monique, thank you for that update. Appreciate it.
Thanks.
Bloomberg's Monique Malima. Up next, Canadian railroads missed revenue expectations driven by uncertainty in the North American trade environment. That's coming up after the break. Canadian railroads missed revenue expectations as trade uncertainty weighs on freight revenue. CN Rail stocks saw their biggest drop in 4 years. Let's get more from Ari Rosa, senior equity analyst at Citi. Ari, thanks very much for joining us. I'm just looking, though, CN seems like it's bouncing back a little bit right now.
It is recovering a little bit today. Yesterday was a little bit challenging, but it's nice to see the bounce back today. I'll be honest. I thought the move yesterday was a bit overdone. Yes, there were some challenges in first quarter. A lot of that related to challenging winter weather conditions, some currency headwinds, which eased through the course of the year. And so, it's understandable why investors are a little bit jittery. I spoke to a bunch of people about this yesterday, and, it's important to remember this is in the context of both CN and its peer railroad, Canadian Pacific. We're up double digits to start the year. So it's understandable. In some respects, it's actually healthy a little bit to have this kind of pullback, right? Nothing ever moves up in a straight line. And so still, good trajectory, a lot of positive things to like. But yeah, yesterday, in terms of what we heard, it was a little more cautious of a tone than we expected. But overall, I think there was a lot to like in the report. And so I'm not sure yesterday's move was entirely justified. So it's nice to see it making up a little bit of room today.
And CP has bounced back as well. With CN, what are the things you liked?
So in terms of the things that we liked, so first off, they reaffirmed their full year outlook, right? Their full year outlook, I think most people would say it was a little bit conservative. They even described it as conservative, but they also noted, look, it's early in the year and there's a lot of macro uncertainty, right? We're dealing with an environment of elevated geopolitical uncertainty, obviously elevated fuel prices, and it's unclear how consumers are going to respond to that. What we've seen, I think we've gotten very used to consumers being resilient, but understandably, I think management was taking a little bit more of a cautious tone. So we like that they reaffirmed the full year guide. We also like that, as you guys well know, the Canadian economy tends to be resource driven. And so we think there's upside actually on more commodity production, but they didn't want to go out on that limb and go out and say that and actually commit to that. So, it feels like there's some upside here. It feels like there are reasons for optimism. But again, it was, I think part of what caused the stock to be down a little bit was that management wasn't willing to fully underwrite that optimism. And so you can understand why investors maybe got a little bit nervous, and then taking a step back, calmer heads are prevailing. And today you're getting a little bit of a recovery. The other thing I would mention that I think is important is, and it's not unique to CN or CP, but the entire North American rail network is running very well right now. And so that actually bodes well for winning volume from truck, and especially in an environment where we're seeing trucking rates rise. When fuel prices tend to be high, that tends to benefit rails relative to trucks. And so again, there are reasons for optimism, but it's a story that has to develop over the course of the next couple of months.
All right, and for CP, I was looking at two different. I was like, we were talking about CN, CP. What were the positives for them?
Yeah, so for CP, very similar. CP tends to be a little bit more of a growthy railroad, but of course, investors then have to pay a little bit of a premium for that. I would say, at CP, management struck a little bit more of an upbeat tone. And what we really like about CP, and this is where, you have to give them all the credit in the world, especially the management team, because they're being creative and finding solutions to drive growth. And so they talked a lot about partnering with other railroads. We have this merger situation that's pending. Union Pacific and Norfolk Southern in the U.S. just submitted their merger application to the Surface Transportation Board, which is the body that oversees railroads. And so there's a lot of uncertainty there, but in the face of that uncertainty, CP and CN both, but I would say CP arguably is even being a little bit more proactive in trying to find solutions, trying to be proactive in driving growth and kind of brushing aside some of the competitive concerns that a lot of investors seem to have around what is a transcontinental U.S. railroad. What are the implications of that for the Canadian rails?
All right, and could we see mergers with either of those two, or is this probably the one and done when it comes to mergers?
That is a great question, and it's very much a topic of debate, and it depends who you ask. one of the things that came up yesterday, and Canadian Pacific's CEO Keith Creel spoke to this, was that if the Union Pacific Norfolk Southern merger gets approved by the STB, it could open the window for further consolidation among the rails. And so the initial take would be, yes, perhaps the Canadian rails could be at a competitive disadvantage. That said, if it drives a further wave of consolidation, it could actually ultimately work to the benefit of the Canadian rails, although then you get into a very tricky discussion. It's almost like a chess game around who merges with whom, what are the terms under which they merge. For Canadian National, there's some specific barriers to consolidation that are a little bit in the weeds, so we don't have to get into it too much. Mm-hmm. But it's a little bit harder for the Canadian rails to merge, and so depending who you ask, I can identify a dozen people who will tell you this is great and it's going to drive a lot of incremental growth for the rails, and then a dozen people who worry about service impairment and worry about consolidation risk and who worry about competitive threats from consolidation. And so right now it feels like a coin flip. But the good thing about the Canadian rails, and this is where we actually like, so we're buy rated on both CP and CN. And the reason for that is if you look at the Canadian rails right now, they trade at one of their largest discounts to their U.S. counterparts in the past decade. And for us, that's a really nice setup to say, look, these are high quality assets. Again, the networks are running really well. So there are a lot of reasons to like them. But again, we're dealing with an environment of elevated geopolitical uncertainty and elevated uncertainty around the competitive risks because of this M&A situation.
All right. And throw in Kuzma. What kind of a factor is that right now for the two of them?
I'm sorry,
Kuzma.
What specifically?
The negotiations coming up.
Oh, yes. Oh, yeah. Sorry.
No worries.
USMCA.
USMCA. Well, yeah.
South of the border, yes. We think of it as USMCA.
I'll translate.
That also a big concern. And again, another area of uncertainty. Now, I happen to be in the camp that says, look, the U.S. economy and the Canadian economy and frankly, the Mexican economy as well, they benefit from trade. They're integrated. I think a lot of companies have built supply chains up over the last 30, 40 years on the presumption that there would be relatively free trade between these countries. Now, the flip side, and again, going back to some of the concerns or some of the things that we didn't like, if you look at the areas of that are heavily impacted by tariffs. So we're talking forest products, we're talking about metals shipments, cross-border, of course. Mm-hmm. Those are getting weighed down by some of these tariff concerns. And so we have a cautiously optimistic view on kind of the resolution of USMCA or Kuzma, if you will. Yeah. But generally speaking, look, as long as that uncertainty is out there, it probably will represent an overhang to the rails. Okay. And so there are reasons to be optimistic on the upside. But again, this probably isn't a situation that changes overnight. And in an environment, again, like talking about why the Canadian rails are trading with a large discount to their U.S. counterparts, I think that is one of the tariff risk is one of the big concerns that's kind of hanging over the rails and weighing heavily on investor minds.
All right, we have to wrap it up there. We'll agree. We'll call it the Mexican version. I guess I call it Musca down there, probably, right? In Mexico.
Fair enough.
All right. Thanks very much for joining us.
Wonderful. Thank you.
Ari Rosa is a senior equity analyst at Citi. When we come back, Canada's economy is proving more resilient than expected, but the search for real growth continues. That's next. Shares of Gildan Activewear are trading higher. The apparel company posted first quarter results that beat expectations and saw revenue come in at a record $1.2 billion. Gildan says the integration of its Hanes Brands acquisition is on track with higher savings expected this year. It is also maintaining its full year outlook. We are watching shares of GFL today. The waste management company posted first quarter adjusted profit that missed estimates while revenue beat expectations. GFL also raised its revenue forecast for the full year and boosted its earnings outlook by $90 million. And we'll have more insight on the quarter when we speak with GFL's CEO and founder at 1:40 p.m. Eastern. We'll also talk to us about how GFL is setting itself up for the year ahead. Bausch Health is one of the best performing stocks on the TSX today. That after the Canadian pharmaceutical beat on the top and bottom line in its latest quarter, with revenue jumping 12% to $2.5 billion. Bausch also saw a surge in revenue in its Salix unit and its Solta Medical segment. The company also reaffirmed its 2026 outlook. Well, Canada's economy grew by 0.2% in February, marking a fourth consecutive month of GDP growth. While that points to a decent start to the year, our next guest says the economy has been more resilient than expected, but the country still is missing a long-term growth engine. Joining us now is Mark Parsons, Vice President and Chief Economist at ATB Financial. Mark, thanks as always for joining us. So it's your mixed response to what we saw today. First, on the plus side, it grew. Did it grow enough? And considering where we were a year ago, how are we looking?
Well, look, there's a couple stories here. The one is resiliency. The economy has outperformed expectations. If you would have told economists a year ago that the Canadian economy would grow 1.7% in 2025, they'd say, "You're kidding me. That's way too high." Well, that's exactly what happened. So we have the resiliency story. I think we've had a lighter touch on tariffs than we expected with the CUSMA exemptions. But this is an economy that's still trying to find its legs. It's looking for a rotation more to investment in exports. That's been the struggle. My only concern with this report is that it seems like a lot of the growth we're getting in the first quarter is consumer driven. And with higher energy prices, you wonder how sustainable is that?
And where would you like to see the growth coming from?
Well, look, this is, if you look over a long period of time, you see consumer and government-driven growth. So, per capita GDP has been an issue in Canada. The growth has really been coming from the consumer and the government. And if you look at the projections that the Bank of Canada put out yesterday, that's really the story in 2026, is that, the consumer and the government's going to do the heavy lifting. What we need is a rotation into business investment. So we need to, build major projects that will translate into better exports and give us a more sustainable growth driver. Because, interest rates aren't going to come down any further. In fact, they likely move higher within the current inflation environment. How much more does the consumer have to give? I don't think they have a lot more left in the tank. And in fact, today's estimate shows that in March, there seems to be a bit of a pullback in the retail sector. So some early signs of fatigue and not able to sustain these gains.
Okay, with the government, we did see it did shrink in February. I think it was 0.3%. Is that what you want to see?
Yeah. Well, look, the federal government still has big spending plans. You saw they took some of the additional surplus that they weren't expecting and put it into some tax measures and spending measures. The Carney government's trying to tilt the focus of spending towards investment, so improving the productive capacity of the economy. That makes sense. Because that's what we need. The question is, will it catalyze private sector investment? If it's just government, money going into projects without the private sector, that would be a bit of a concern. So what you're seeing in the GDP data, I think, is, pullback in that operating spending, getting spending, down a little bit on the operating side. But you still see that driver coming from, say, like military spending, defense spending, that's in the data as you get to the 2% NATO target.
What will it take, do you think, to get business investment fired up here?
Well, the approach that we're taking right now is to accelerate certain nation-building projects through the Major Projects Office. I think that's a really good start. We need to get the ball rolling on getting things built in Canada. An optimistic take would be if we get some of these major projects across the finish line and shovels in the ground, that could shift investor sentiment and say, hey, we can build big things here in Canada. The concern would be, well, this government-led approach, where you're really kind of picking the projects, might not translate into the gains that you're expecting. So I think that we're moving in the right direction. I think we've acknowledged the severity of the problem. The question is all about execution and whether we start to see some progress on some of these projects.
Your thoughts on Shell and ARC, that deal there?
Yeah, well, to me, that is a game changer. I mean, we have LNG Canada Phase 1, and this makes LNG Canada Phase 2 much more likely. I think Shell sees that as a strategic asset, the gas to feed another LNG facility, or at least an expansion. Actually, in the oil and gas sector, this is where we see some optimism. We just did a survey of producers, and they're feeling a bit better, actually quite a bit better, about their prospects. The only thing they're waiting on really is this MOU between Alberta and the federal government. Can we land that? What are the details going to look like on carbon pricing? Are we going to have the pipeline capacity? But I think this is a sector to watch. There's a lot more growth there. Right now, it's more on the production side, but to get that CapEx increase in building new facilities, I think you're going to need a little bit more policy and pipeline certainty.
All right, and Bank of Canada holding pat, no real surprise there. Where does it go from here? I mean, it has a lot to juggle, doesn't it?
Oh, it does. So on the one hand, they're concerned about the Iran war and the impact that's having on energy prices, and whether that becomes generalized, the inflation basket. That's what they say. If this environment lasts for longer, meaning like oil prices don't decline, they could be in a position where they have to hike. So, but they also said, look, if the CUSMA negotiations don't go well, maybe they have to cut. So where does that leave us? Well, we think the balance is tilted towards a hike versus a cut. We have them on hold this year. But if I had to choose, I think this was a bit of a hawkish statement, and the Bank of Canada what might be considering more hikes than cuts. Again, on hold this year, have them increasing next year to 2.75%, the mid-range of neutral. But I wouldn't expect rates to go lower, that's for sure.
All right, and do you think the one increase, or could there be more?
Yeah, look, they're wait and see this year. I think what's very clear is they want to see how this unfolds with CUSMA and also the war in Iran. They're not in any rush to move because they want to see if these pressures sustain themselves. So again, wait and see. But we see 2 rate hikes next year, and that's just getting us back to that mid-range of the neutral, which they call 2.25 to around that 2.5 to 2.75% range.
All right, we have to wrap it up there, Mark, but thanks very much for joining us.
Thanks so much.
Mark Parsons is Vice President and Chief Economist at ATB Financial. Well, shares of Bombardier are soaring today after the Montreal-based aerospace manufacturer boosted its guidance. We'll get more on that after the break. Shares of Bombardier are up sharply today after the Montreal-based aerospace manufacturer boosted its guidance based on the performance of its services business and a sharp increase in free cash flow. Let's get more from Nicholas Owens, equity analyst focused on aerospace and defense at Morningstar. Nicholas, thanks very much for joining us.
Thanks for having me, Roger.
All right. It sounds like a lot of good numbers there. What are some of the best ones that you were looking at?
Well, for first quarter to see such a jump in cash flow was eye-opening, and I think the biggest explanation is really very simple, which is they sold a bunch more planes, so took orders, and people put down a deposit when they place an order. So they got the money. Now they got to go build the planes. And
they have what is it, 20? Their backlog's at $20 billion.
Yeah.
And so how, looking forward with that, is that a problem, or is that something you feel they can handle?
Well, it's interesting. So it's lovely when you're the manufacturer to have a backlog like that. But if it's too big, what that represents is if you called them tomorrow and said, "I'd like one of your planes, please," they'll tell you you have to wait 2.5 years, and so that starts to become a problem because there's a competitor who might be able to sell a similar plane, in less time. So that's why they've been adding a little bit to some capacity investments to enable them to move the planes out a little faster. But in general, it's let's call it a high quality problem. The products are in demand for sure.
Yeah, there are worse problems to have in life, aren't they?
Yes, indeed.
And their service revenue, a huge jump in the first quarter, 25%. Where did that come from?
Yeah, that's an interesting story. I mean, they made a, let's say, strategic decision a couple of years ago to increase their footprint of stuff that they're able to do on the planes, once they're out in the wild, so to speak, and have a higher participation, a higher market share of servicing the planes. And that's really seems to have been working very well as a strategy. And then the other stat that backs that up, that they shared in their report, is that usage of the planes is up. So every time you take off and land, you kind of check a box of having run a cycle on the plane, and that brings you closer to some kind of maintenance event or check-in. And so their ability to do more on the aftermarket has gone up, and people using the planes has gone up. So that gets you to that kind of a jump in services revenue, which is pretty nice to see for them strategically.
And is it something they can grow? Is there more room there?
Yes. I want to say a handful of years ago, they estimated, the company gave an estimate that they were, I want to say, below 30% of the market share of, let's say, available services that they can do on their own planes. So basically, third parties were doing the work on the Bombardier jets. And their goal was to get that to 50%. I think they're going to reach 60% in a year or two here. So it's pretty good outcome. And from a financial point of view, from a stock analyst point of view, it's lovely to see an aftermarket component of the business that gives you sort of longer term visibility into cash flows, and it's usually fairly profitable or predictable in terms of what financial performance they can expect from these types of service events.
And with this success, I mean, is this vision from management, or is this demand of a good product?
Well, I mean, if you go back a couple more years, Bombardier is a very different company than it was. And extremely. I think, the stock's up partially on just good numbers, but also I think more and more people have realized that this is a different company than what they thought it was. And the skepticism, let's say, has been falling away. There definitely was a strategy, in terms of saying we want to be focused on business jets, the large, long-range business jets, and increasing their footprint on aftermarket is a very sound strategy. The next thing that they're talking about doing is adding capacity in one way or another, maybe through a small acquisition, to participate more in the defense market, where these business jets are modified for communications, surveillance type missions, so that a bunch of electronics and stuff that gets put in the plane, that they could, again, third parties do that today. Usually Bombardier might be able to increase their ability to do that. So a couple, let's say a handful of planes a year would have these high-tech fit-outs as part of the business.
And I mean, going forward, is oil prices a concern for Bombardier? Do people hesitate about leasing or buying these planes if oil prices go up, or is that just something that's factored in?
Ooh, good question. When you're using one of these planes, really all you're doing when you decide to go from A to B is you're paying that incremental cost, the operating costs, the pilot's time, the fuel, and so forth. So, and kerosene certainly has gone up a lot in the last couple of months, but it's about where it was in 2022. I think it's just kind of, and you could argue, I would argue, it's a small portion of the total cost of the vehicle. Yeah. So I don't think it strongly influences that marginal use. I mean, it would be interesting to see, let's say at the end of Q2, do flight hours on business jets flatten out or continue to rise the way they were in the last few months. All right, Nicholas, thanks very much for joining us. We appreciate it. Thank you. Nicholas Owens is an equity analyst focused on aerospace and defense at Morningstar. Coming up, Aclara Resources shares are up just over 500% in the past year as investors zero in on who can build rare earth supply chains outside China. For more on that strategy, we'll be talking to the Aclara CEO. That's next. Aclara Resources is up just over 500% over the past year. Ever so little dip today. It's been driven by interest in rare earth processing and separation, the most constrained part
of the supply chain, with China dominating that step. Attention has turned to who can execute it elsewhere. For more, we're joined now by Ramon Barrua, CEO of Aclara Resources. Ramon, thank you very much for joining us.
Thank you very much, Roger, for inviting me.
You're looking to take on China. They dominate this sector, and specifically that separation issue. How do you see yourself taking them on?
Sure. Look, our strategy is focused on doing that on an integrated basis. No, we are very fortunate to have two ionic clay deposits. These type of deposits are copy-paste. They're exactly the same as the ones that China have in their southern provinces. And the main attributes there are that the metallurgy is extremely simple, and they also contain the heavy rare earths that, as you probably know, are the most valuable rare earths of them all. But not only do we have the mines and the concentration stages, but we have also announced the development of separation technology in the US. We're developing that technology at Virginia Tech University with the intention of deploying that technology in a plant to be built in the state of Louisiana. So I think that integrated approach differentiates us from other competitors, given that we will be able to deliver from mine to magnet a solution that is exactly what the US and its allies require right now.
And why do from mine to magnet? Why not just focus on one specific area?
Yes, that was our original plan, but the problem is that the integration with the other stages is rather complex. No, it's not that simple. And we believe that there are significant synergies in terms of costs, speed to market, and operational efficiencies by doing it all together. No, so we believe that through this strategy, we're going to be able to deliver sooner and more cost efficient than any other company in the world, the magnets with heavy rare earths that are needed in the technological industries that require them.
Now, with Virginia Tech and the laboratory partnership you have going, or the Argonne National Laboratory Partnership, it's only a pilot plant. How close are you to the real thing?
Sure. Look, the pilot plant is really the key ingredient. No, once you develop the technology, once you are able to have the ability to separate rare earths, a technology that is specifically designed for our two ionic clay deposits, then deploying that in Louisiana will be rather straightforward. No, the equipment is not sophisticated. It's basically mixer settlers, which are tanks with agitators and pumps. So it's not too complex. The key is designing, how the chemical equilibrium will occur in a series of around 350 to 400 tons. No? Hence also our partnership with the Argonne National Laboratory. With them, we're developing a digital twin where in the pilot plant, we're going to generate at least a couple of years of data that will be fed into this digital twin in order to minimize the risk of ramp up and, again, chemical equilibrium in this sophisticated plant.
And with all this, I mean, the heavy metals, a lot of people have the rare earths, and people look and think it's very dirty. How are you trying to offset the footprint that you may leave behind with this?
Certainly, that's a great question, especially because we have a great answer. No, the reality is that the type of deposit that we have, again, the ionic clays, here. The extraction of the rare earths from those clays is rather easy. The chemical bonding is a very weak bond, and we're able to extract that using just water and ammonium sulfate, which is a common fertilizer. Through the process that we have designed, we do not use any explosives. There's no crushing, there's no milling. We're able to fully recirculate water with 95% efficiency, and we fully recirculate the fertilizer in our system. And most importantly, we do not concentrate radioactivity in our concentrate. We have already achieved a purity of around 97.7%. That's something that we published in our feasibility study from our mine in Brazil. We are targeting a higher number than that in order to bring the product as clean as possible into the US for separation.
Okay, and now you're on the TSX. Anything, and you're going to build this plant down in Louisiana. Do you see any place in Canada that you could be working with?
Not right now. No, we've made a very thorough analysis in order to determine where the best place for the plant was. We have chosen the state of Louisiana because we have acquired an LED certified site that already has most of the permitting already pre-approved by the state. We are also in the process of receiving economic grants in the form of tax exemptions and certain very direct grants from the state as well. There's access to the chemicals that we're going to be needing as reagents in the state. And there's also a very, knowledgeable workforce and consultants near Lake Charles, where we plan on building our plant. So we're very happy with our decision, and we're right now 100% focused on that. In the future, we're looking for other alternatives. No, we have 2 mines, as I mentioned. We don't want to stop there. We're looking for more mines. We're active on the exploration front. And Brazil is a country also that has that is advancing itself to position as a hub for rare earths development. No? So we have not discarded. As a matter of fact, we're looking very seriously at a second separation plant, probably in Brazil in the future.
And we are pretty much out of time, but how much do you hope to produce when things get going, and how would that compare to China? I need about 15 seconds answer here.
Yes, in terms of heavy rare earths, we are going to be producing around 15% of China's official production of heavy rare earths.
Perfect. We have to wrap it up there, Ramon, but thank you very much for joining us.
Thank you. Thank you for inviting me.
Ramon Barua is the CEO of Aclara Resources. Market calls coming up next on the show. We have Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James. Her focus, Canadian and U.S. large caps. That's it for Morning Markets. Thanks for watching. We'll see you back here tomorrow.